So we're looking at investigation, fraud investigation, and engagement process. Now, as a forensic accountant, you are tasked to investigate fraud and provide evidence whether fraud really took place or not, isn't it? And that evidence goes to the court, and the court will base on that evidence to prove the to prove someone wrong or right, or in other words, to justify the case that is before them. Now, what is fraud investigation in the first place? Now, when we talk of fraud investigation, we're looking at the process that consists of the steps in systematically gathering, or in other words, we're looking at the process consists of the steps in a systematically gathering and reviewing evidence for the purpose of documenting the presence or the absence of fraud, isn't it? Simon? So the main aim is to do an investigation, a systematic investigation, or a process where you are trying to get evidence or information to justify the presence of fraud, or in other words, the absence of what? Fraud, isn't it? People can say, this guy is a thief, there is a fraudulent activity taking place in this particular office. Now, you don't just have to conclude, you have to go down, investigate, and find evidence, tangible evidence, and prove that this person has really engaged in what? Fraudulent activities or not. So you are, as a forensic accountant, you are there to justify whether fraudulent activity took place or not. Now, how does it work? Now, the fraud investigation normally commences as a result of some indication that fraud may have what? Incurred, isn't it? So there must be indicators of fraud altogether. Maybe you gave someone money and is failing to account for that. You've given someone to facilitate a training or activity, and you discover that that person is failing to liquidate, or is failing to bring information or evidence to support the activities. He is failing to tell you how many people attended the activity. He is failing to tell you how much was given to each person in that particular activity. He is failing to account that money. So you cannot conclude that fraud took place, but there is an indication. Until that is proven, that person remains innocent. So we're saying, if there is an indicator, there are tips, you have been tipped, or there are complaints, or you have noted some accounting anomalies, or you have seen that there are internal control deficiencies, or in other words, you are looking at the analytical anomalies, you can conclude that these are indicators of fraud. So what do we do to actually help to uncover this fraud activity? So our role is to prove whether there is fraud or not, isn't it? So we're saying fraud investigation occurs when there is an indication that fraud might have taken place, isn't it? Or how do you know that these are the indicators? You're looking at the controls, deficiencies, a number of things that are called anomalies. You check on people are tipping you, so you conclude that fraud is taking place. Let's do an investigation. Now, before you take up an investigation, you should, both parties, or you, the investigator, and the one that are being investigated on, should have an understanding, or should actually understand that matters of flood, or anything that has to do with flood, will end up in the courts. Altogether? Yeah. It will end up in what? In the court. Meaning to say, whatever you're investigating, as an investigator, you have to stand before the court and provide the evidence or the report on what you have investigated, isn't it? Relating to flood, isn't it? So, that has to be known. Now, because these matters are going to the court, it is very important that you conduct an investigation competently, or in other words, systematically, with utmost care. Altogether, you need to conduct it what? Utmost care. In other words, it has to be done systematically. You have to put together your investigative skills. You have to put together, you have to document as much as enough evidence so that you are able to justify your points, isn't it? So this is very important. So you cannot just conclude on matters that are going to court. Each evidence that you come across that you feel is important to support the argument, that one has to be documented, has to be kept and presented in the court of law, isn't it? Yeah. So, under fraud investigation, basically, under fraud investigation, we're looking at systematically gathering and reviewing what? Evidence to document the presence or absence of fraud. So what you're doing is systematically reviewing. You're looking at evidence, isn't it? The question is, people are saying, people have come to you to say, your fellow co-worker, your fellow worker is stealing money, or is spending money that was budgeted for something else. Yeah, that's a tip. You cannot conclude on that. So you need what? Evidence. So where is the evidence? Out here. Out here. If you send someone to buy a phone in one of the shops in town, and that person comes and say, I've bought this phone at 150,000. And that person doesn't bring any receipt. Would you believe that? So telling you about the price is not a problem. But the next thing is, that person should be justified. Again, how would you justify the 150,000? You need to provide what? Evidence. What is the evidence? The evidence is the receipt that you got from the seller, isn't it? Now, some receipts could be authentic, some could not be authentic, isn't it? So, if you are given the receipt, you don't just believe that receipt. In forensic accounting, you don't just believe any receipt. You have to test the authenticity of that receipt, the genuinity of that receipt. Is this receipt genuine? Or is this real? Or is this receipt really generated by the seller? So, some receipt may have the logo, may have the contact details, the email addresses, and the phone numbers. You can find a way of finding out whether phones of that nature are really selling at that price. You can send them an email to send them a quotation. You find that when you send them an email, they send you a quotation, and the quotation says those phones are selling at 90,000, and yet the receipt tells you that the phone was bought at 150. What does that mean? It means the one whom you sent to buy either connived with the seller to inflate the price or not. That is a fraud, isn't it? That's an indicator of fraud. So, now the evidence is that you have managed to send an email, and the email has been responded. The seller has quoted the price, the actual price of that particular phone, isn't it? So you can take that as evidence before the court of law. Say, no, look at this. I sent this one to buy a phone. He brought this receipt that the phone is selling 150, but I made my own investigations. I've discovered that the same phone at the very same shop is selling at this price. So I consider this as a fraud. Let me see. Now, how do you investigate fraud? There are basically 4 steps that are involved in fraud investigation. So these steps include the engagement process. Altogether, engagement process. We have 1, engagement process. And then 2, we have what we call evidence collection. Evidence what? Evidence collection. And then 3, we have what we call so you have what we call the reporting process. Reporting process. And 4, we have what we call the loss recovery process. Loss recovery what? Process. So these 4 processes are engaged when it comes to we'll discuss them in brief because our next topics will be discussing these points in detail. So let's look at engagement process. Engagement process. An engagement is, when I say this one is an engagement, we're looking at a contract or an agreement, isn't it? An engagement could be what? An agreement or a contract, isn't it? If I say, so, before you commence any investigation assignment, the first thing that you need to do is to get engaged or to sign an engagement letter, isn't it? An engagement letter is more about a contract between you, the investigator, and the client, isn't it? So that engagement letter or engagement document has to indicate the terms of reference. Altogether. So before you sign that engagement, it is very paramount for you to meet up with the client altogether and get to understand the nature of the fraud that is about to be investigated. Altogether, what is the nature of the fraud that is about to be investigated? Additionally, you also have to understand the important facts relating to that investigation. If it's about, if investigation is about, or it's a fraud, or it's about fraud, or it's about theft of money, you need to understand what could be the important factors. How did it happen? Yeah? I'll give you an example. If assuming you have a school and someone says you work as a bursar at a certain school and your role is to collect school fees and bank, and the boss says no, I was trying to do reconciliations on the number of students you have who have paid and actual cash that you have. And I discovered that there's a shortage of maybe 300,000 kwacha. Now the question is, there is a shortage of 300,000 automatically, okay, that man, oh, the man is missing, and you've proven, say, no, this man is missing, but you don't know who has stolen it. But the prime suspect is the person, the one who's doing the collection, isn't it? Now, if you are an investigator, if they say there's 10,000 kwacha missing, and we want to engage you to investigate that, first of all, you have to understand the important facts within that scenario, isn't it? What could be the important fact? Now, you have to check first. Okay, how did it happen? Students were paying cash. Do you have a bank account? Yes, we have a bank account. Okay, so why did you opt for cash? So that's the first step you have to understand, isn't it? Because if students are paying cash, the risk there has to be shared. Altogether, the owner of the school is a problem because he has allowed for cash payment. Two, you look at the safety of the bursar. Is the bursar when cash is collected? So what happens before you go to buy? No, we have drawers. Okay, are those drawers lockable? No, they are not lockable. That's important fact to consider. Because if the drawers are not lockable and someone is keeping money in the office, it means there is the chances of that money being stolen are just very what? High. That's the step. That's where you start. That's where you start now. So you have to understand the environment where the client is operating, and now so that we are able to develop a strategy that will help you uncover what has been lost. Again. So what I'm saying here is that you have to know important facts. You have to know the key players. Again. Who are the key players? Who are the people that are involved in the collection of fees? So there's the bursar, the head, and what. So those key players you have to know, and you have to understand their caliber. Again, before you decide to do an investigation, and then before you accept the engagement, or before you sign the contract that you can be an investigator, it's very important for you to do what you call, or to perform a conflict check. A conflict what? You do a conflict check. Forensic accountants are supposed to be investigators, and investigators are supposed to be free from any conflict of what? Interest, isn't it? Okay. If I'm told to investigate fraud at a certain school or secondary school, and my brother is the headmaster at that particular school, and I have been engaged to investigate, obviously, if the bursar connived with the headmaster, it would be hard for me to implicate, or it would be hard for me to implicate my brother. Even if I have tangible evidence that my brother was involved in that, it will still be hard for me to actually make my brother or involve my brother. I'll still find a way of protecting him, isn't it? Why? Because I'm not independent, isn't it? But we are supposed to be independent. Independent in the sense that we have to be seen, people should look at us as being independent. Our mind should be independent, and our skills should be also independent. So we should be looked as people who are independent. We are there to do the job objectively. So we have to avoid being subjective. So it's very important to do a conflict check, whereby you're looking at this organization. What is this organization to me? Do I know anyone there? Who are the people in there? Is there anything that can impair my independence? Will I be able to deliver within this environment. So it's very important to understand the environment and make sure you make yourself free from what? Any conflict. Okay. So then after, when you have done, you are satisfied, you have done the conflict check, and then forensic account will sign a contract or engagement letter with the client, and this engagement letter is a legal agreement binding two parties. That is, say, you as an investigator and the client who is looking for your services. Are we together?
Yeah.
Do you have any question? So the best process is what? Engagement. How does it work in the engagement process? Can you briefly explain what happens under engagement?
I think it's more like engagement is a process where you have to sign it. It's more like a contract and agreement between the investigator and the company. So before you start, you engage yourself in investigating before. You have to make sure you check the key. I mean, you check the conflict. Yeah, you analyze the conflict checks in the contract.
Why is it important to check to conduct a conflict check
So that
when you're doing a forensic audit?
for you to be aware of what you're going to face, and it also makes you to know, like, that for you to be aware and to avoid some conflicts in the process.
What is a conflict?
The conflict means
So looking something that will make you fail to make an objective decision, isn't it?
Yeah.
Or an objective judgment. Something that will allow you to be subjective, to be biased in one way or the other, isn't it? Because you know someone, you have a relation there. Maybe you're investigating a bank where you have a loan. So you still want to protect the bank, you see. You have an interest in that scenario. But in this case, you have to be independent. Now, the second process is, as we've discussed, we are looking at the evidence collection process. Now, we'll discuss this in details in our proceeding topics, but now, just want to look at it briefly, isn't it? Now, evidence collection process is very important, isn't it? That's the process where you're trying to bring together the evidence to support or in support or against the allegation, isn't it? That's the point where you would want to have tangible evidence that will favor the allegation, or the tangible evidence that will actually work against the allegation. In this case, the allegation is the fraud itself, isn't it? Now, when you are collecting an evidence, so evidence collection is based on the fraud theory approach. It's based on what? Fraud theory approach. Fraud theory approach, where people have their own facts or ideas or their own concepts to say, we believe man has been what? Stolen, isn't it? they'll tell you that we want to investigate, but they have their own, they have already believed some facts, money has been stolen. So they just want you to prove to them that they are saying the right thing, or they are not in the right channel, isn't it? Just want you to prove to them whether the allegations are right or not. Now, how do you do that? So we're saying, there are 4 steps that have to be followed in according to fraud theory approach. The first thing is to analyze data, or the data has to be what? Analyze. So analyze data is to be the first step under evidence collection. What's it? Someone is saying, is alleging, or is making an allegation on fraud. What do you do? Before you support that person, or before you convince that person, you are independently have to do a thorough search or a research on the data, on the information relating to the allegation, isn't it? If you see about 50, you have to gather information relating to what? 50. How did it occur? So they'll tell you, no, what happened is this. We sent this person to go to Blantyre to facilitate a training. The budget for that particular training was 5 million. Okay? And this person was supposed to do these activities. Maybe there were 5 activities. You're supposed to pay participants. You're supposed to hire a hall for the meeting. This person was supposed to refund transport for the participants. Now this person was also supposed to buy refreshments for the what? For the participants. Now those budget lines, if you add those budget lines, gives us a total of 5 million. And this money, 5 million, was given to him. Okay? So, under normal circumstances, when you are working as an accountant and you have been assigned to do what we call, to do what? You have been assigned to do, to facilitate an activity. When you are facilitating an activity, you are the project officer or the accountant. They'll give you the money. And the money that you are given is an advance. Okay? So the 5 million here is what? An advance. So you start now analyzing the data. That money has not been spent. Understood? Ready? You have just been given money to facilitate the training. So in our records, we'll record that as an advance. We'll record that as a receivable. See more than? We will not record that as an expense. We say, what's Matthews? Matthews has been given 5 million advance to facilitate the training. So we say, this 5 million is an advance, is a receivable to the organization, because the activity there's a possibility that the training or the activity could be cancelled, isn't it? Or there's a possibility that you might not spend the whole 5 million. You may spend less, or this and that, isn't it? So this one becomes an expense when you have actually spent, isn't it? So you start spending it. I'll spend on fuel so much. You spend on refunds, transport funds. You spend this part of 5 million on what? On refreshments. You spend part of 5 million on DSS or allowances. Okay. So, by the end of the day, you are supposed to liquidate, isn't it? you do what we call liquidations, whereby you are trying to issue a summary or report to say, out of 5 million, this is how I spend the money. I bought fuel amounting to what? Maybe 100,000. This is the receipt. That money is liquidated. These are the receipt of what I did for the refreshment, the funds, and what have you, isn't it? Now, you spend, if you spend 4.5 million, what it means is that the 500,000 has to be returned, isn't it? So out of the 5 million, which was the receivable to the organization, you have only spent 4.5. That means the receivable now drops from 4.5 to 500. Now, let's assume you have spent, I want you to understand it, how float practical, how float works, isn't it? Well, yeah, are we together? So I should be able to give you the practical part of it. There could be a possibility that now, so they'll tell you, no, these are the receipts that you brought us, and if you add the receipt gives us what? For 4.5 million. And we discovered that 5,000 was not what? 500,000 was not spent. Under normal circumstances, that 500,000 was supposed to be returned to the office, isn't it? How do you do that? You're supposed to go to the bank and deposit the money and get the deposit slip, part of the deposit slip attached to the what? To the documents that you are presenting. So when you're writing a summary, you say, I got advance of 5 million, I spent 4.5, and I deposited what? I deposited 500,000. That balances off, no problem there. So if that 500,000 is not deposited, and you decide to forge some documents to look like you've spent the whole money yet you haven't spent. So those could be the indicators of float. Or alternatively, you might spend the whole 5 million and fail to bring receipts, or you say, no, I've spent 2 million on transport refunds. Now I'm going to fund my participant. The question is, you need to have a participant what? A list. So you check participant list against the attendance register. Who attended the meeting? And who are these people? Are they contact? So you find that Munduzamina has spent 2 million on transport fund. Now when you go, you check, was on that participant list there should be a name of the person, how much you got, and the contact number and the receipt. If you make calls, you find that 20 or 30 people are saying, no, we did not attend that meeting and we did not get any transport. So you find that is a first step to it. Yeah, so it's an indicator of flow. So what I'm saying here is you should be able to gather information and analyze it critically so that you have a better understanding of the flow of things. What happened and what went wrong? What is the problem that we're facing? Where is the problem coming from? So what went wrong? That is very, very important. Understood? Asante. Okay. Now, having analyzed the data, the next step is to create a hypothesis regarding a possible fraud. Because we are basing fraud is based on a theory, then you need to be hypothetical, isn't it? You have to create a hypothesis and educative what? Guessing. You know what a hypothesis is?
Yeah.
So, and that's what most people do, because they already have that in mind to say, this guy stole the money went missing, and the fraud then activities took place. So, their role is to create a hypothesis regarding possible fraud. To say, I believe fraud really took place. Okay? So, you need to use the information that you have analyzed to support that, but okay, you need to use that information to relate to, okay, you should be able to, after creating a hypothesis, you should be able to say, okay, how do I relate the information or the scenario to this hypothesis? Now, this fraud, who is affected with this fraud? What is affected? Why should we have this fraud? When and where and how did it take place? So those are some of the things that you need to do. So whenever you have a hypothesis, you need to gather information, because you have a theory and you develop a hypothesis, then you do your investigation, then the findings of your investigation should be used to test what? The hypothesis, isn't it? So the next step is testing the what? Hypothesis. So the test, when you are testing a hypothesis, is either the test to support the hypothesis, or the test will not support the what?
Yeah.
So you can either support. So in this case, if people are saying man has been stolen, that's the hypothesis. That's how they are putting it up. Say money, this guy has stolen money among this. So you do your investigation, you discover that money was not stolen, but some documents were just misplaced, so they couldn't account for that. Then your findings will actually either support what has been support the hypothesis, or disagree with what has been. So whatever the case, if the hypothesis, if what the investigation, if the test is in support of the hypothesis, then you have to amend, or you have to go ahead and conclude. If the tests are not in support of the hypothesis, then you need to refine and amend the hypothesis. If that person, from your investigation, discovered that man was not stolen by that person, or there was just a misplacement or misunderstanding between the staff, then you have to amend. You have to refine and amend hypothesis. So the next step is refining and amending the what? Hypothesis. After testing, you need to refine or amend after you've done the investigation. Then the last one is you have evidence to support the fraud theory. Now the fraud theory is being supported with the evidence that you have gathered. Now, when you are collecting evidence, altogether, when you are collecting evidence, there are a number of evidence that have to be collected, isn't it? There are categories. Evidence could be any information relating to the allegation, any information relating to the fraud that is being what? Investigated, isn't it? Any document that you feel will actually or play the part or play the role in the fraud that's being investigated, that one is an evidence. So what I'm saying is that What type of evidence do we need? So now there are 4 types of evidence that can be gathered in the evidence collection process. So one, you can have physical evidence. You can have what? Physical evidence. What else? What is physical evidence?
I think that accuracy or test, like it's in physical form.
Physical form. A good example.
Receipts.
What?
Receipt.
A receipt.
Yeah.
In the physical evidence. What else?
An invoice.
An invoice is a physical evidence. Something that you can see physical, isn't it? Okay. So anything that you see physically will give you a physical what? Evidence. Okay. So you can get physical evidence as one of the evidence that you may gather in the course of in doing your investigation. For example, maybe you went to see a building. A building could be a physical item. 2, you can also get what we call document evidence. Altogether? For example, if you give someone a contract to supply you with 500 bags of beans, and you sign a contract with that particular person, that contract that you sign becomes a document, isn't it? That one is a document evidence. Whereby you say, no, we have a legal agreement, and this person was supposed to supply me maize or beans. We paid them 50%, and there's only supplied the quantity which is not even equivalent to 50% we paid him. And there is nowhere to be seen, and is not cooperating. So that's an indicator of fraud. So that document would act as what? It is it. You can also look at other documents. Maybe there were emails that were exchanged. There were some invoices that were sent. Other important documents that you signed or were exchanged between 2 parties. Those will act as evidence. Now, how do you also gather evidence? That some evidence could be observation. So we have observation evidence, or physical evidence, document evidence, and observation what? What is this observation evidence that we're talking about? Sometimes, as a forensic accountant, as an investigator, sometimes you can gather information through observation. Observation is when you go to an office, you just observe what is happening there. People are doing their job in accordance to their job descriptions. You are not doing anything, but what you're doing is just observe. Are they complying with with the standard procedures? For example, I'll give you an example of if there is a fraud relating to stocks or inventory, maybe you have a warehouse and discover that some stocks there are missing, isn't it? So if stocks are missing, it means someone has stolen the stock or something fishy has happened to the stock, isn't it? Which means there is need for you to quantify the number of bags that are missing, and those quantities should be translated into what? Monetary value, so that you are able to tell how much has been lost. Now, in the course of doing that, you need to do a stock take, isn't it? Or a stock count. Now, when doing a stock count, you are an investigator. You will not do the stock count. You allow the staff to do the stock count, and then observe, isn't it? You simply observe how they are doing the stock count. So you look at the procedures that they have relating to stock count. You get yourself information. For example, what we call the standard, international accounting standard. For example, if a stock, you talk about IAS 2. What are the provisions in international accounting standard 2 inventory? So you relate that to that, so that you are able to understand or to gather information relevant. You are able to observe and conclude altogether. So on observation, in this case, you look at how they pack their bags. Well, sometimes assuming you are counting bag of rice, isn't it? We have seen it somewhere where people at stocks, they claim to have 100 bags of rice, isn't it? Well packed. So what they did was, in actual sense, there are only about 60 bags of rice. So what they did was to pack their stock systematically. So they had to put bag of rice and the inner rows, they had to pack bags, but with sand. They had to pack sand in 50 kgs and put it there, and surround that sand with what? Bag of rice. So if you don't do, so when you go for a stock take, you check and see. So you find that how they are doing it, because they know this is not rice, it's sand. So the way they're doing it, you would be very skeptical. So why are they doing this? So your presence there is to observe what is happening there, to check if those bags are really packed with rice or not. So that's very important. Those things happen. Now, that evidence could be through interview. So I've interviewed what? So interview is an acceptable what? Evidence. How does it work and what is it?
When you go to ask the people or the clients and organization, the people first, and what the answer they give you, and that's the evidence to influence. So we tell them what they
So for example, assuming I'll go to the very same example that we had to say there is a claim that the staff went to pay allowances for participants, isn't it? Or allowances or transport funds for participants. And there's a claim that this participant did not get the money, isn't it? Or they didn't even attend the seminar or the activity. Now the question is, how would you gather that evidence? So you can go physically, meet them, and interview them. Or you can interview them on a phone and you ask them to record, if you could record the conversation. So you ask them questions, if they attended the meeting or not, how much they were given, So they will give you all the evidence. So this evidence that you're gathering here is through what? Interviews. You're asking questions, interacting and asking questions so that you're able to get the information that you need. Do you have any questions? Before we can move on. So, the next step is the reporting process and loss recovery. Of also things we'll discuss them in detail in the next classes. But now I'll just explain them in brief. Say, you have done the investigation, you have collected data, isn't it? Relating to flood. What do you do next? You come up with a report. Altogether, you say, there was this issue. There was a theory or a hypothesis that was created. We have conducted investigation, we have analyzed the data, we have tested the hypothesis. Indeed, our test is in support of the hypothesis. Now, what do? You issue a report, reporting on the matters that you have investigated, issues that you have handled in your investigation, so that you are able to understand, you are able to give the third party the information they are looking for. So you issue a report, and then if indeed there was a loss, maybe there was a loss in terms of money was lost, or assets were lost, or any kind of loss that took place, what will happen is that there is need for recovery. That money has to be what? Or those resources, those assets have to be recovered. Now, under recovery is when now the issue goes to court. The court has to actually pass a judgment and have to decide on how that money should be recovered. It could happen that the court will say, will order the person to pay back the money, or the court will decide to forfeit some of the, if you're an employee, they can forfeit some of the benefits. They can talk to the pension manager and forfeit your pension, so that that pension covers up the money that you lost. If you have other benefits, that has to be decided by what? By the court. Understood? Thank you. So, this is just an introduction. I wanted you to understand the engagement process and fraud investigation before we can look at what our area that I want us to discuss now is so let's have a look at what we call fraudulent financial report. Fraudulent what? Let's have a look at fraudulent financial what? Reporting. We know for sure that as an accountant, your role is to prepare. The last stage of an accountant is to prepare financial reports, isn't it? financial statements have to be prepared so that management or any other stakeholders are able to use them and make decisions. Altogether? Now, for you to prepare financial statement, it's very important for you to have information, isn't it? That's why you do the bookkeeping and what have you, so that you are able to gather or you're able to have information that will enable you to prepare financial reports. That's why we have book of origin entry, we complete the double entry, we have balancing of the rentals account, then we prepare the trial balance. From the trial balance we prepare financial reports in accordance with what? IFRS 1 or IAS what? 1. So professionally, you're supposed to present, okay, the information that you present in the financial statement should reflect what is on what? On the ground. If it's revenue, present the revenue that the company has actually realized. If it's the cost of sales, you present the cost of sales that has been actually realized by the company. You are not required to overstate anything. You are not required to understate anything. Present matters understand, so that those who are trying to make decisions, they should make decisions based on the information that reflects what is on the ground. If you have made 10 billion, present 10 billion. Don't reduce it. Don't add something, is there? Now, there are possibilities where accountants or finance experts may decide to do their financial statement fraudulently. Altogether? Or another way of saying, they may become fraudulent. Or they may engage themselves in fraudulent what? Reporting. Or fraudulent financial reporting. Now, what is fraudulent financial reporting? Fraudulent financial reporting is a deliberate misstatement, or omission of financial accounting information. It is a deliberate misstatement or omission of financial accounting information intended to deceive stakeholders. Intended to deceive what? Stakeholders. So when an accountant knowingly presents financials or financial statements in a manner that departs from the actual true or fair, or in a manner that departs from the actual performance of the company, that kind of reporting is fraudulent. So what I'm saying is that deliberately you decide to give a report that does not give any reflection of what is happening on the ground. That is fraudulent reporting. Now, what could be an example of fraudulent financial reporting? When the company decides to under or overstate what? Profit. When profit and or overstate what? Profits. That one what is understatement?
Stating.
Huh?
Stating below the actual in terms of profit. It's like stating the even income. Stating the profit, which is actually below the actual profit.
Why do people do that?
To reduce or avoid the taxes and other expenses by the government and shareholders.
So, companies may decide to over or to understate revenue. For example, if you have generated 10 million, you may decide to report 6 million as your revenue. People do that. Why do they do that? One, they would want to avoid tax. When they want to declare a loss, they will decide to understate profit. Altogether, professionally, that is wrong. Altogether, that's against code of what? Ethics, isn't it? As accountants, we're supposed to have a code of ethics. So, what we're saying here is that when companies understate revenue, that's fraudulent reporting. When companies overstate expense, overstate revenue, sometimes you have only generated 10 million and you report 20 million. That's overstating. When companies overstate revenue, that's fraudulent reporting. Why do they do that? Sometimes they would want to get donors attraction, say, or investors attraction. Some investors would want to invest in a company that they feel when they put their money, that money will be able to multiply and bring them more money, isn't it? So, what companies do is to inflate figures so that they are able to attract investors. If you want to get a loan from the bank, the companies may decide to inflate the revenue so that they report a good profit by the end of the day. Because the banks know that if the company is able to make a profit, therefore they will be able to pay back the loan, isn't it? If they're making a loss, how are they going to repay the loan back? That becomes a problem, isn't it? So what we're saying here is that we're looking at a situation whereby companies are reporting in a fraudulent manner by understating or overstating just to meet their own needs or objectives. Okay, so that is not acceptable. What could be the other example of fraudulent reporting in our financial reporting? Overstatement of what? Expenses. When you overstate expenses, that's being fraudulent. Why should you overstate expenses? And why would you do that? Sometimes companies would overstate expenses so that they declare a loss. When they declare a loss, they will avoid income tax, isn't it? They won't be able to actually pay income taxes. So that is another challenge that we have. Another example. Understatement of expenses, isn't it? If expenses could be overstated or understated. Either way, both understatement and overstatement is fraudulent in nature. It's not acceptable before. It's not acceptable, and it's against the provisions and international accounting standards or international financial reporting standards. We are not supposed to do that. So that's fraudulent reporting. What would be that example?
For the state,
Fraudulent reporting.
no, sometimes not indicating some important part.
Huh?
Missing some important information in the report.
Missing some important information.
Just to reduce some expenses.
For example, what would be a good example of that? Okay. We know what in financial reporting, we're looking at what? Financial statements, how we present them. So in income statements, then analogy, you can inflate the figures as a revenue, or you can tamper the figures. Revenue can be overstated, understated, cost of sales you can understate, overstated, expenses could be overstated or understated. It's not acceptable. If you talk of the balance sheet, sometimes the companies may decide to overstate assets. Okay. May decide to overstate assets. For example, you know for sure you only have 3 motor vehicles for the company, and you indicate that you have 10 or 5 motor vehicles. Where are the 2 coming from? So that one is overstated, isn't it? Why do you do that? So that the company, the financial position of the company should look nice, isn't it? People should see that this company has a big value or is well valued as compared to other companies. So that when investors come, they know if these guys don't pay us money, we'll be able to sell a real asset which can be sold, and we'll be able to recover our money. So they're not doing that in good faith, but they're just doing that to actually mislead the investor so that they make decisions based on the wrong what? Information. Again, because if you say you have 5 houses, yet the company only have 2 houses, what happens is that the value of 5 houses will be greater than just the value of 2 houses. So when I make a decision, I'll say, okay, if these people have 5 houses, what it means is, if they default, if I give them a loan and they default, what happens is I can sell those buildings and recover the money. But, in that sense, that building, that what? Company is not what? So that's it. So it's very important for you as a forensic accountant to check. If someone says, these are the assets that we have, 10 motor vehicles, 5 buildings, we have land, 10 hectares, Or whatever they do, they say, what you have to do is that you tell them to list down all the assets. If they are fixed assets, let them list down all the fixed assets that they have and independently do a physical verification. One, first of all, to do that, you have to check if the ownership of those assets. Does the company really own those assets? What about the title deed? The title deed? Is the title deed in the name of the company? Altogether. So you're trying to investigate. But if you don't have those skills, these guys can end up lying to you, can end up giving you wrong information. Then you have to physically verify, do these assets really exist? So you have to go and verify the existence of those particular assets, because under problem financial reporting, the asset could be understated, could be overstated, isn't it? You check, sometimes companies may deliberately miscalculate depreciation, isn't it? You know, it's a motor vehicle, and they'll tell you, no, we want to depreciate maybe 10%. But you know, motor vehicles is between 20 to 25% per year. So you have to look at those factors. They'll tell you, no, this is land and building of combined that will not depreciate. No, we know land doesn't depreciate, but the building depreciates. It's about 1 to 3%. You can depreciate, isn't it? So you have to check those things. So if you're not, if you don't have the skills, those guys will end up telling you the wrong information, and you end up believing the wrong what? Information. So what we want you to understand is to critically analyze the scenario. So the asset, to avoid overstatement of asset, get the listing, look at the ownership, do the physical verification, check the reasonability of what? Depreciation charge. Are they using the right rate so that you avoid? So when you're doing your collection, you check that and document. Yes, they use the right rates. No, these rates are not in line with the provisions of the accounting standard, and what have you. Then check with the other asset register and what have you. Apart from asset, for example, I've seen companies on the same asset. I've seen companies overstating receivables, right? Or debtors. You know what receivables are? They'll tell you they will overstate what? Receivable and understate payable, so that when you are trying to analyze the financial statement, if you are trying to compute the current ratio, the ratio should be good or positive, or in a way that someone will be able to be satisfied with the performance of the company. So they will tell you we have 10 million receivables, but in that sense maybe the actual value of the receivable is just 1 million or 2 million. Can you see? So what do? You know, you have to test if the it's very important for you to test if the receivables are what? Overstated or not, isn't it? So it's the same thing. You get the listing your receivables and check each and every receivable, and you look at the period. If a receivable was existing for 10 years or 5 years, 3 years, that has to be what? A written off, isn't it? It's no longer receivable. And you know for sure, and through investigation, you have noted that this receivable are not going to pay back your money, and you still keep them under current asset. That has to be investigated, and critically, the financials have to be adjusted. And the receivable figure has to be what? Adjusted. Can you see? Are we together?
Yeah.
payables, same thing, can be understated sometimes. So it's very paramount for you to do a good job, a clean job on that. Can you give me a scenario where financials could be or balance sheets could be overstated, apart from what we discussed here? Other scenarios. Accruals. What are accruals? Huh? Accruals. Accruals, that's what are accruals? Accruals are owing, isn't it? For example, if you are assuming you bought a laptop, okay, let's put you bought a phone at 20,000, and you're paying by installments, isn't it? And phone your regular September, and your financial year ends 31st what? December. And as of 31st December, you discover that you're only paying 150,000. That's it. So the 50,000, because your cutoff is 31st December, the 50,000 will be what? An accrual or an owing, outstanding what? Payment, isn't it? Okay? Because as a 31st, that money was still outstanding, was an accrual, so to be carried forward, you pay maybe the next year. But when you're preparing your financials using matching concept, where you match all the expenses and revenue that year, get it? So how do you present that? What you're going to do is you will still charge 200,000 from a financial analyst, operating expenses, and the 50,000 will appear in the balance sheet as as a current liability. Understood? Is that not the point? Is not a current liability. So the 50,000 will appear in the balance as a current liability, but we need to charge the whole amount in the income statement. So some accountants will understand that concept, others will understand it but deliberately will choose not to do it for their own reasons. So we have to check we have to understand about accruals and check how we handle issues relating to accruals. Even prepayments. How do you charge a prepayment? How do you treat a prepayment in the financial statement? For example, rentals. The rentals do not appear in advance, isn't it? So how do you treat them? How do you treat them? How? Rentals. How do you treat rentals in the book of accounts? Rentals are paid in advance. If your rentals are paid quarterly, and the last quarter is from October to December, October to December. No, maybe the last quarter is December to February. and your rate is 200,000 per month, and you're paid 600,000, and your cut-off, your financial year ends in January, in December, what do you do? What it means is that, what do you do? So prepayments are what? Receivables. I mean, yeah, I carry that, isn't it? Well, what's another receivable? Was you only spend what? 20,000. Yeah, February, January and February, it's a prepayment. And that one will be treated as what? Carrying asset. It's a receivable. That's how it's in. So it's very important to understand such concept. Are there any questions? Any other questions? Are there any questions or any explanations before we? So, we have covered a number of things. We have looked at introduction to fraud investigation and engagement process. We have discussed fraud investigation. Why do we investigate? That means there is a call or there is an allegation or another an indicator of fraud. People are suspecting fraudulent activities, so we need to investigate. And we have looked at steps involved in what? Fraud investigation, engagement process, evidence collection process, reporting process, and loss recovery process. So I've also looked at engagement, we've discussed engagement process, evidence collection process, types of evidence, and we're also looking at fraud and what? Reporting. Our time has come to an end. This is exactly 2 hours that we've covered. Thank you so much.
On my processes, steps in fraud investigation, earlier with reporting process, they always
recovery, loss recovery.
What if one can report and then you don't you find out there is no what if they like anytime there is a car?
No?
You have what in one can report the state process you have reported and then there is no damage or any loss that has occurred. So is this still going to occur?
What happens is after reporting, you have to take the issue to court. It's up to court to proceed based on the fact that they're presented or not, isn't it? But the final decision is with the court. And say, whatever you're doing, you have to present evidence before the court. So it's up to them. Maybe they'll be convinced of what you're presenting or not. So they have to decide at the end of the day, what should we do? Yeah. Oh, thank you.